Hello and welcome to this July edition of Amundi's Market Review. Financial market performance this month broadly reflected enthusiasm for the bolder monetary policy moves to ease financial conditions and support the corporate sector with liquidity injections. The Federal Reserve was not only aggressive but ahead of the curve, reiterating its whatever-it-takes stance. The ECB increased its purchasing emergency package, as we hoped, while the take-up of the TLTRO refinancing loans for banks and the latest monetary survey showed that it is eventually stimulating bank lending to the real economy. The Bank of England and Bank of Japan are on the same ultra-easing line. In June, we saw a resurgence in virus infections that slowed down the pace of business reopenings, inducing an increase of volatility across the full spectrum, equity, fixed income, and currency market. Confidence indicators improved, prompting the rebound of activity after the bottoming between first and second quarter. We think lockdowns won't be large and will be selective to contain damages to economic activity. Equity market rose further this month by almost 3% for European stocks, followed by 2% for the Chinese Hang Seng. The S&P 500 was flattish, while Japanese topics drifted lower, minus 82 basis points. Gold confirmed its gains year-to-date, adding another 2.5 in June. Oil moved back to $40 a barrel, both on the WTI and Brent indices. After being the clear winner to date, the US dollar slightly weakened. In particular, the euro appreciated to 1.12. While structural forces are building for a weaker dollar going forward, the collapse of interest rate differentials and a secular deficit, we think the euro moved too far and too fast on reduced perception of political risk in the eurozone. On this front, there has been some progress, but we need to wait until the July, if not September, EU Council meeting to have some tangible conclusions on the recovery fund. Nominal government rates for the developed market closed barely lower, minus 2 basis points on the German 10-year Bund and 3 basis points for the 10 years US Treasury. Vice versa, real rates moved higher, plus 20 basis points both in Germany and in the US. In our view, upside potential on interest rates will be tempered by the strong demand coming from the central banks and the recalibration of yield curve in the short end. Governments are in fact financing their debt issuing T-bills and short-term bonds. Therefore, tensions in the long end of the curve will be eased. As we said last month, the road back from COVID-19 will be a tough one. Expectations that the pandemic is over may be too optimistic, and any slip-ups could see markets heat up again. While it's true that government and central banks have introduced extreme measures, more will be needed, particularly outside the US, where the magnitude of measures doesn't really match the economic damage. Moreover, geopolitics will increasingly take center stage the further we move forward toward the final phase of the US presidential elections. To conclude, we cannot ignore this day after direction, but we must exercise caution, be wary of leaping from depression to euphoria, but rather shift from uncertainty to navigating a careful path forward. Thank you for listening. Please keep safe and see you next month for another market review.